The bank is one of several institutions under investigation by the U.S. Department of Justice and 3 different financial regulators. Court documents allege a former TD Bank teller accepted bribes to launder money for drug traffickers.
Oh, hi! Welcome back to my YouTube channel. In today's episode, we'll talk about the current U.S. federal investigation towards one of our biggest banks. As well, we'll discuss a little bit about what might have happened if this scam would have been prosecuted by Canadian authorities. At the end, we're going to give some insights regarding accounting principles, some tax implications, and other issues. So without further ado, buckle up.
There are 2 types of accounting that you have to understand. There's something called cash basis accounting and accrual basis accounting. Most medium to small businesses really operate on a cash basis type of accounting system. You go in the store, you pay for a product, cash in, cash out, simple. Accrual basis accounting is where it gets just a little sticky. We recognize revenue when earned and expenses when incurred, regardless of when cash is received or paid out. So think about what that means. Say, for instance, I have a business and I have a friend that has a large business, and I think I'm gonna get $10 million of sales from my friend. What I don't know is my friend's business is about to file for bankruptcy. I can book revenue on my income statement and say I have a revenue of $10 million. Well, what if I never receive the cash? I've used the word cash and I've used the word revenue. They don't mean the same thing. Cash is cash. If I give you $10 million cash, you know you have $10 million cash. If I say you have $10 million in revenue, that doesn't mean you have $10 million in cash. So that's why you see companies recognize revenue in crazy ways sometimes because of whatever they've told Wall Street.
What GB Bank have been telling Wall Street is they have a lot of cash in their reserve, which is good for them because it means that the bank has more money to lend and invest to make more money for the shareholders. Let us remember that the main stream of a bank's revenue is interest. And the banks earn interest by lending money that they don't own or investing that money that they don't own. The U.S. Department of Justice is currently investigating the bank for $653 million, alleging money laundering from drugs, and they have 2 open cases, one in New York and the other one in New Jersey. The proof is focused on how Chinese gangs groups use BizBank, the Tourne of Dominion Bank, aka TV, and other Canadian banks to claim money from the U.S. fentanyl sales. That's the first case. The second case is in New Jersey. Some employees were charged for accepting bribes to facilitate their laundering on drug money. Allegedly, these people has been doing this for 1 decade. And the funny part is the Canadian bank having just in the US for almost 2 decades. It's important to mention that criminals recklessly target financial institutions to launder money because it's how the system works. They have to noodle their money in order to buy people, or to buy guns, or to purchase raw material, or to create the drugs, or to transfer the drugs, or to pay their employees. If you were wondering what's the relationship between a bank being investigated for money laundering and cash accrual methods for recognized revenue in accounting, and what yet? The answer is everything. I'm just kidding. Let me elaborate. The real answer is accounting principles. Translating accounting principles to Canadian tax law, you can find in subsection 34.1, where any individual who carries on business activities, they need to recognize the income as individual. They will move forward to subsection 96 sub 1. They created another exemption for partnerships. The partners need to separate everything as if they were individuals. By the other hand, corporations have the options to either use the cash method or the accrual NAPA. According to subsection 125.7 sub 1 of the Income Tax Act of Canada. Now, if you are a little bit confused, the previous information was to give you a context on how it works because as individuals, we cannot use TD bank strategy. But wait, what strategy TD Bank is currently implementing? Then they give you the answer. TD Bank is by using that true method of accounting, they don't need to recognize the revenue right away. So they can play with timing. They were delaying and tying together money flow in the drug industry with their regular clients. As an interesting thing to consider is the drug money is gigantic compared with the average in the big law monthly income. We're talking about millions other a couple of Nelsons. So they being tricky than regulatory authorities in North America until they finally got caught by the US. And Canada looking the other way, as always. However, the only thing they do when they caught is to make the chief executive to give a press release, say that's unacceptable, we're going to implement safeguards, and they define. The fine they already knew they're gonna pay. Did you know what else they get to use in that wrong method of accounting? Provisions. This is when we say the devil is hidden on the details. Where's the provision, you might be thinking? Let me give you the real-life example. The bank announced an initial $400 million provision for regulatory penalties. That's another accounting trick. And you know what happens when you do provisions? You create something that is not real in the books, and you're allowed to expense it. That means it is deductible. That means you pay less taxes, and when you get caught, you just pay the fine. $650 million in this case. It might sound like a lot of money, but I can assure you that they actually made more, probably 5 times that amount. And you want to know what's the funniest thing about that? Nobody goes to jail. Chief executives, senior staff, and high-level management, these folks have been in these positions for years. And they absolutely knew about it, and probably they gave instructions to allow it. If not, they are stupid because it's literally their responsibility and job duty. However, if someone does go to jail, they will toss the lower employees to the lions, the ones who were following orders.
Andy ended up engaging in what we know today as earnings management. And about a year and some change later, the FBI came knocking at his door. The reason why was really about timing. His bosses wanted to recognize revenue too soon because they wanted to meet Wall Street expectations. And his bosses really weren't interested in learning about accounting. They didn't want to know the details about accounting. They didn't want to hear any of that. All they wanted to know was make the numbers work. We're trying to be acquired, just make it work.
I never felt like I was in over my head, but reflecting back on it, I was in way over my head.
He didn't get any personal gain. He was following his boss's orders. He knew it was wrong, but he's trying to be a team player.
There became this implied pressure that if we complained, that we were going to lose our job.
And so what Andy did is he overestimated something that made their financial statements look better than they actually should. Andy knew it was wrong, but what is he going to do? Is he going to push back? No, he didn't, and that's what landed him in federal prison.
In Canada, this guy would have been charged with 2 counts, probably either according to subsection 297 sub 1, which is a indictable offense, or a summary conviction for manipulate, falsify, or make false entry in books for not more than 5 years. Just to tap a little bit here, in case you don't know about the difference between what an indictable offense and a summary conviction is. It's easy. Indictable often means serious crimes, and summary conviction means the pretty ones. The second crime would be for fraud, which is false pretense to defraud the public of any person. This crime is a hybrid as well. For this crime, he would have spent up to 4 years and a fine for up to $5,000. As you may correctly assume, in Canada, we don't have that much law regarding to financial crimes, while in the US, have countless laws to fight financial crimes either on land and around the world. Moving forward into earning management. It's a fancy word to use accounting techniques in order to cut the books, but there is more than TD Bank's strategy. We could employ the numbers to create the false impression of having financial healthy records, and top management receive more in bonuses. or to deflate income in order to pay less taxes. Accountants have to follow the International Financial Reporting Standards, IFRS, for companies that have stocks in a market, such as in Wall Street, just like TD Bank. And the small ones, corporations, they can elect to use either IFRS or other Latin rules. In our Maple and putting them, small corporation could use something called ASPE, which stands for Accounting Standards for Private Enterprises.
The financial statements are the property and responsibility of management. Management compiles them, management makes all the decisions around the transactions. The auditor comes in to say what management has said is true or false. But there's a little bit of conflict here, because guess who pays the auditors? The client. So how would your client like it if you have bad news to tell them about the financial statements that they just put together? Andy is a perfect example of a CPA that was placed in a very difficult situation. He knew generally accepted accounting principles, but yet he didn't feel comfortable pushing back. So accountants and auditors often find themselves in a really tough dilemma. Did Arthur Andersen, who was the auditor for Enron, did they really want to lose Enron as a client if they said, these transactions, you don't have the right things disclosed, this is wrong, this is wrong, this is wrong, this is wrong? You know what Enron would do? They just go find another firm.
Sadly, as a business owner, we need clients in order to make money, and that's why anything of this doesn't make any sense. So let me give you a little bit of context. In a corporation, we have the shareholders or the owners of a company. These guys hire the executive managers to make the money. However, a corporation is a separate entity, which means it's like another job. But in common one, the duty of the executive managers is to perform in the best interest of the corporation, not the shareholders, which are the ones who hire the executive managers. In order to evaluate the executive managers, the owners or shareholders hire external people, the auditors. So when this has happened and the managers are trying to hide dirty things for the owners, it's easier for us, the auditors, to tell the owners that something is happening. This is also the case where the owners try to do dirty things and the executive managers refuse to follow those orders. In this case, auditors cannot do anything about it. But what is the owners and the managers are included into this? Do the stuff on behalf of other people, to defraud them. That's when we have this major conflict of interest because they really want us to lie. And if we don't do that, we can either lose our jobs or we lose our clients. But if we do that, we are breaking the law, our code of conduct, and the trust in our profession. And we might go to jail. But now, with the auditors I pay to actually look the other way. As always, this sort of action is doing at top management, and they know what is happening all the time. But they just pretend to not know and give instruction to lower levels so they can take the board.
When we limit enforcement to fines alone, it's really easy for a person or a business that puts profits first to just compare the size of the fine to the potential profits and pick whichever one's bigger.
Pick whichever is bigger. And that's exactly what they do, especially in Canada. If they let they fine of $5,000 and they actually are making billions, it's literally laughable. But anywho, thank you so much for staying at the end of the video. Let me know what you think about this immoral, ethical, and complex conflict of interest issues that us as financial professionals face all the time. Because it's not the matter of when it happens, it's what to do when it does happen. I'll leave the full video through about the Big Think channel in the description down below. See you next time. Bye.